Okay, so let's look at the indirect method for preparing cash flows from the operating activities. So remember, the investing and financing activities will remain the same regardless of whether we're using the indirect or direct method. Now, something really interesting to note here, I think, on this slide is 97.5% of all companies use the indirect method. So I'll probably spend a little more time discussing that with you. It really is easier in a way. It makes more sense. So more businesses, I think, do prefer to use the indirect method. And this is this little green backed image is really important. It's kind of like a little cheat sheet to walk you through the process. The way that we start is with our net income, which you can see here. So you start with your net income, and then we make some additions or subtractions to that. Add back depreciation. The reason we add back depreciation to our net income is because it was subtracted when it was calculated to begin with, and it's not a cash expense, it's a non-cash expense. Then we're going to add back any losses on sale of long-term assets or subtract out gains on sale of long-term assets. Usually we don't see those at this level too often, but make a note there. If you saw those, you would do exactly what it tells you to do. And then we subtract any increases in current assets other than cash, or add decreases in current assets other than cash. So you have to think a little bit about what current assets are. Things like supplies, inventory, prepaid rent, all would fall under that current asset section. Then we will add any increases in current liabilities or subtract any decreases in current liabilities. Those increases and decreases are from one period to the next. So what was the change from the previous period ending balance to this period's ending balance? And that will give us ultimately net cash provided or used from operating activities. So let's take a little look here. You can also refer back to this nice little chart as well to help you calculate changes in current assets and long-term assets. So you just come here and you figure out, did we have an increase or a decrease in the item over year or period to period. So if it's a current asset and you had an increase, it gets subtracted from that income. If it's a current asset and you had a decrease, then it gets added. Current liabilities that increase get added, and current liabilities that decreased will get subtracted. This is a pretty good slide as well. So it kind of explains to you why we're doing some of the things that we're doing. The reason we add back depreciation expense is because it was subtracted to arrive at net income, but it doesn't require the use of the cash, which I mentioned to you earlier. We deduct an increase in accounts receivable because it reflects sales revenues that are included in net income but not yet received in cash. Let's see, deductions. Reasons we would deduct an increase in merchandise inventories because cash was spent to acquire the increase in inventory. And we would add an increase in current liabilities because cash has not yet been paid for the products or services that have been received during the fiscal period. Just to mention as well, I've touched on this earlier too. One key number to watch for is whether or not the cash flows from operating activities are going to be positive or negative. Over time, an organization should have positive cash inflow from operating activities. If they're consistently generating a negative cash flow from operating activities, that's going to be an indicator of trouble. Obviously, you have to have cash, so cash is mandatory to continue operations. And when cash flow from operating activities is consistently negative, it translates into financing activities, meaning we have to borrow or issue more stock. So consistent borrowing to fund day-to-day operations is ultimately going to cause an organization to go bankrupt. Okay, so let's look at an example. This one says East Inc. reports $125,000 of net income for the year ended December 31st, 2005. Accounts receivable increased by $7,500 during the year, and accounts payable increased by $10,000. During 2005, East reported 12.5 of depreciation expense. So what you're probably going to do, well, not what you probably going to do, but what you may want to do is go back and find this little cheat sheet and start at the top and work your way down. So we always start with our net income, and it told us in the problem our net income was $125,000. Then we know we need to add back any depreciation or amortization expense. Well, it says that we had depreciation expense of $12.5, so we're going to add that back. And then we would add back any losses on sale of long-term assets or subtract gains on sale of long-term assets, which we don't seem to have here. And then we will look at changes in our accounts receivable, which is a current asset. So it increased by $7,500. So if current assets increase, right here, they're going to be subtracted. And then we had an increase in accounts payable, which is a liability of $10,000. And increases in current liabilities are added. So let's flip through, see the process. Start with net income, add depreciation expense of $12.5. Then we said we would subtract the the increase in accounts receivable, that gets subtracted. And then we had an increase in a current liability, accounts payable, so increase in current liability gets added, which you can see here. And ultimately, if we take our net income of $125,000, add the depreciation expense, subtract the increase in accounts receivable, add the increase in accounts payable, we get cash provided by operating activities of $140,000. And you can see the note down here. If we use the direct method, you would get the same $140,000 cash provided by operating activities. Let's do a little bit more in-depth problem. So here we have B&G Company's comparative balance sheet. So we can see for 04 and 05. And they've been kind enough to go ahead and show the difference between 04 and 05 here. So in 04, cash was $22,000. In 05, it went up to $63,000. So that's a $41,000 increase. So that's going to help us when we start preparing our financial statement. Also tells us that net income was $105,000. Cash dividends declared and paid were $40,000. Bonds payable of $50,000 were redeemed for $50,000 in cash, and common stock was issued for $35,000 in cash. So we're going to prepare the entire statement of cash flows here. Start with, again, net income. That's our starting point, which we were told was $105,000. Then it tells us here we need to add back any non-cash expenses, which would be depreciation and losses, or subtract any non-cash revenues and gains. Well, the only thing we have to worry about here is depreciation expense. Let's see if I can flip back really quickly. So depreciation, we see accumulated depreciation went from $32,000 to $66,000. And the entry, when we make that journal entry, is debit depreciation expense, credit accumulated depreciation. So that's a $34,000 in depreciation expense that we need to add back. We also should be figuring out what current liabilities, what current assets and current liabilities we have. So this one, remember, accounts receivable is a current asset, inventories is a current asset. Now land is long-term assets, so that's going to be on our investing section. And equipment is also long-term, so any changes will fall under the investing section. Accounts payable, this is going to be a current liability. Bonds payable will be under financing as our common stock. Okay, so we know we need to look at the changes in these two accounts along with, that was accounts receivable and inventories, those are both current assets, along with the changes in accounts payable. So an increase in a current asset, we'll see, an increase in a current asset gets subtracted, which is what we did to accounts receivable. We had a decrease in inventory, which is current asset, gets added, so $19,000 gets added, and then a decrease in our current liability, you'll see, gets subtracted. So if we go ahead and take our $105,000 Then take our adjustments and add those all together. We'll get an additional $36,000. So net cash provided by operating activities was $141,000. Okay. So now let's go ahead and complete the investing section. Remember, that deals with long-term our long-term assets, and we highlighted those a minute ago. Let's see. We had long-term assets. Land went down $25,000 from 04 to 05, and equipment went up. Well, if land went down, that means we sold some land, so we'll have an inflow of cash of $25,000. And if equipment went up, that means we bought more, and cash would have decreased by $70,000. So let's see. That's exactly what we've got here. So proceeds from sale of land, $25,000. Purchase of equipment is a negative. Net cash used by investing activities is negative. We had more outflows than inflows. And then we have our financing activities section that we need to look at next. And there was some information that was provided to us early on. Let me see if I can find it for you. Okay, so this additional information gave us the net income, which we already used. Cash dividends declared and paid were $40,000. Okay, so that tells us that's going to be an outflow of cash. Bonds payable of $50,000 were redeemed for $50,000 cash. That's another outflow. And then we issued stock for $35,000 in cash. That's going to be an inflow for us. So if we went ahead and listed all three of those out under our financing activities section and added them together, we'll see that net cash used by financing activities was $55,000. So now we're going to take all three of these together, the 141 plus the 45 plus the 55, and what we get left with is $41,000 increase in cash. We'll have to go back and figure out what our beginning balance in our cash was on January 1st. And you can see, looks like it was $22,000, because that would have been the ending balance from the previous period. And that's right, that's what we've got there, $22,000. And then we add those two together, and we get the ending cash balance of $63,000. That will also be the balance that we show on our balance sheet.